Welcome to this Get It training session on understanding Regulation W. In today's banking environment, financial institutions are often part of large corporate families that include mortgage companies, broker-dealers, insurance subsidiaries, and other financial affiliates. While these relationships can create business opportunities, they can also introduce serious financial risk if banks move money or assets between affiliates without proper controls. That's where Regulation W comes in. Regulation W establishes rules that limit how banks can conduct transactions with affiliated companies in order to protect depositors, maintain financial stability, and ensure fair market practices. In this training, we'll break down what Regulation W is, why it exists, the key rules banks must follow, and how it affects real banking operations today. Regulation W plays a critical role in protecting the banking system. At its core, the regulation is designed to prevent banks from taking excessive risks with their depositors' money by transferring resources to affiliated companies. Without safeguards, a bank might be pressured to support a struggling affiliate, such as a brokerage firm or mortgage subsidiary, by extending loans, purchasing risky assets, or guaranteeing obligations. This could expose the bank to losses that ultimately threaten depositors and the stability of the financial system. Regulation W addresses this risk by limiting how much a bank can transact with affiliates, requiring certain transactions to be secured by collateral, ensuring transactions occur on fair market terms. These protections help maintain confidence in the financial system, which is essential for the stability of banks and credit unions across the country. Regulation W is built on two important provisions of the Federal Reserve Act, Section 23A and Section 23B. These sections were originally introduced in the 1930s after the Great Depression, when regulators discovered that banks had been transferring money and risky assets to affiliated companies, which contributed to widespread bank failures. Section 23A focuses on quantitative limits and collateral requirements for transactions between a bank and its affiliates. It restricts the total amount of exposure a bank can have with those affiliated entities. Section 23B, on the other hand, focuses on fairness and market pricing. It requires that transactions with affiliates occur on terms that are comparable to what the bank would offer to a non-affiliate customer. Together, these two sections form the backbone of Regulation W, which is administered today by the Federal Reserve under 12 CFR Part 223. The core purpose of Regulation W is to promote safety, soundness, and fairness within the banking system. Specifically, the regulation serves three main goals. First, it protects depositors by ensuring that banks do not expose insured deposits to excessive risk through affiliate transactions. Second, it maintains financial stability by limiting the amount of financial support a bank can provide to affiliated companies. Third, it ensures fair dealing, requiring that transactions between banks and affiliates occur at arm's length and at market terms. In other words, banks cannot give special treatment to companies simply because they are part of the same corporate family. To understand why Regulation W exists, we need to look back at the banking crises of the early 20th century, particularly the Great Depression. Before modern banking regulations were in place, banks often had close relationships with securities firms and other affiliated companies. In many cases, banks would transfer money or purchase risky assets from these affiliates in order to support them financially. When those affiliates failed, the banks themselves suffered heavy losses, leading to bank runs and widespread financial instability. In response, lawmakers introduced Sections 23A and 23B to create clear rules governing affiliate transactions. Over time, these rules evolved into the modern Regulation W framework, which continues to protect the financial system today. Today, Regulation W establishes a comprehensive framework governing transactions between banks and their affiliates. This framework includes several key elements. First, the regulation clearly defines what qualifies as an affiliate and what transactions are considered covered transactions. Second, it establishes quantitative limits on how much exposure a bank can have with affiliates. Third, it requires collateral for certain transactions, ensuring that the bank is protected if the affiliate cannot repay its obligations. And finally, the regulation enforces the market terms rule, ensuring fairness in pricing and transaction terms. Together, these requirements help regulators manage risk and maintain strong oversight of banking operations. One of the most important concepts in Regulation W is the definition of an affiliate. An affiliate is any company that controls, is controlled by, or is under common control with a bank. This typically includes entities within the same bank holding company structure. Examples of affiliates may include mortgage lending subsidiaries, securities broker-dealers, insurance companies, investment advisory firms, financial technology subsidiaries. Because these entities operate within the same corporate family, there is potential for conflicts of interest or financial support between them. Regulation W ensures that banks treat these affiliated companies carefully and responsibly. Regulation W identifies certain activities between a bank and its affiliates as covered transactions. These transactions are closely regulated because they create direct financial exposure between the bank and the affiliate. Examples of covered transactions include loans or extensions of credit to an affiliate, purchasing assets from an affiliate, issuing guarantees on behalf of an affiliate, accepting securities issued by an affiliate as collateral, investing in securities issued by an affiliate. Because these transactions can transfer risk from an affiliate to the bank, regulators impose limits and safeguards to protect the bank's financial condition. One of the most important safeguards in Regulation W is the quantitative limits placed on affiliate transactions. These limits ensure that a bank cannot become overly exposed to any one affiliate or to the entire group of affiliates. The regulation sets two key thresholds. First, a bank's transactions with any single affiliate generally cannot exceed 10% of the bank's capital, stock, and surplus. Second, the total of all covered transactions with all affiliates combined cannot exceed 20% of the bank's capital, stock, and surplus. These limits help ensure that the bank maintains adequate financial strength and independence from its affiliates. In addition to quantitative limits, Regulation W also enforces the market terms rule, which originates from Section 23B of the Federal Reserve Act. This rule requires that any transaction between a bank and its affiliate must occur on terms that are comparable to those offered to non-affiliated companies. This includes factors such as pricing, credit terms, fees, risk exposure. The goal is to ensure that affiliates do not receive preferential treatment simply because they share the same corporate parent. This rule helps maintain fair competition and transparent banking practices. Regulation W has a significant impact on daily banking operations. Banks must carefully monitor transactions involving affiliates to ensure they remain within regulatory limits. This affects several areas of bank operations, including lending decisions involving affiliate companies, treasury management and liquidity transfers, asset purchases and sales, service agreements within a holding company structure. Banks must also maintain strong compliance monitoring and reporting systems to track these transactions. Compliance teams play a critical role in ensuring that all affiliate activities remain consistent with Regulation W requirements. To remain compliant with Regulation W, bank employees must understand several key terms. These include affiliate, a company that controls, is controlled by, or shares common control with a bank. Covered transaction, certain financial transactions between a bank and an affiliate that are subject to Regulation W limits. Capital, stock, and surplus, the regulatory capital base used to calculate the 10% and 20% transaction limits. Market terms requirement, the rule requiring transactions with affiliates to occur on terms comparable to those offered to unrelated parties. Understanding these concepts is essential for ensuring that banks operate safely and remain compliant with federal regulations. Let's quickly recap what we covered. Regulation W is designed to protect banks and depositors from excessive risk related to affiliate transactions. It is built on Sections 23A and 23B of the Federal Reserve Act and establishes rules that limit how banks interact financially with affiliated companies. Key elements include defining affiliates and covered transactions, setting exposure limits of 10% per affiliate and 20% overall, requiring collateral for certain transactions, enforcing market terms to ensure fairness. By following these rules, banks help maintain financial stability, regulatory compliance, and public trust in the banking system. Thank you for participating in this training on understanding Regulation W. A strong understanding of affiliate transaction rules is essential for maintaining compliance and protecting the integrity of the financial system. If you have questions or would like to learn more about banking regulations, financial compliance, or risk management, be sure to explore additional training from the Get It series. Disclaimer: this content is for educational purposes only and is not financial, legal, or investment advice. Please consult a qualified professional before making any financial decisions.